After the record rally we've seen over the past year, it's not unjustified for some investors to be skeptical about how much further equity markets can rise from here. Have we priced in all the good news? And yes, there are areas of the market that still look very expensive. Tech, NASDAQ, these still valuations look very pricey in our opinion. But there are areas of the market that there is still room for that performance and valuation gap to narrow. They've lagged significantly in recent years and stand to benefit from the economic recovery. So how to position in this global equity market where there are some areas that do look stretched? First of all, look outside the US. The international developed markets are one of the areas that we like. International equities have underperformed the US for many, many years. As you can see in this chart, it's showing you that the developed international markets have underperformed the US markets on a rolling 5-year basis for at least a decade. They're much more tied to the economic recovery. When you look at an area like Europe, Europe stands to benefit more than the US does in the global economic recovery. They rely much more on exports. And if you look at this table, what it shows you is that the European equity market is made up much more of those sectors that we like, the sectors that are tied to the economic recovery, industrials, materials, financials. These sectors should rally more than your tech-heavy, defensive type of sectors as we continue to see the economic recovery take hold. Emerging markets should also benefit from the global economic recovery because they also are export dependent. Now, while they've rallied significantly from last March's lows, they still do look attractive for long-term potential. And if you look at leading indicators, which are showing how the economy is moving out of the pandemic, they're leading over the developed markets by far. Now, while the US may look like the most expensive market, if you were to look at the S&P 500, for example, that doesn't mean the entire US equity market is out of favor. There are several areas that still do have room for that valuation gap to narrow. What we've seen in the past 2 quarters is that those cyclically oriented value stocks, value sectors, have really started to outperform your expensive tech-heavy growth sectors. You can see in this chart that both from the large cap and the small cap perspective, growth is outperforming value at the fastest pace that we've seen since the dot-com bubble. Now, while these value sectors, as well as small cap and mid cap stocks, have been the leaders out of this pandemic, they're still underperforming your large cap, your growth, your tech by a significant amount over the past decade. In fact, if you were to look at the large cap growth index in the US, it's still outperforming the large cap value index by about 6% a year over the past 10 years. So there's a significant amount of room for this valuation and performance gap to narrow. What is some of the biggest catalysts? It's economic growth. For the past decade, we've seen growth outperform because there's been too many investors chasing too few growth companies. Well, that's changing. We're now starting to see some strong economic growth where we think is going to continue for the next several years. We're seeing interest rates rise as well. These things tend to favor industrial stocks, sectors. They favor financials. They favor materials. These sectors that are cyclically oriented that tend to be more value-centric as well. So we still like that value area of the market. We wouldn't abandon growth, but we're very selective right now, waiting for better opportunities to enter into that area.